You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.
You know, the Indian stock markets have seen a sharp rally in the recent past. I'm sure we've all been witness to it. And that's really the stage for today's podcast. Welcome to PGIM India Insights, brought to you by PGIM India Asset Management Company. And you know, in a scenario like this, everyone wants to participate in this metaphorical gold rush. But should you participate? That's question number one. And if yes, how? Well, that's really the conversation for today's episode. We've got Ankit Jain from PGIM India Mutual Fund as he catches up with Vinay Paharia, Chief Investment Officer, PGIM India Mutual Fund, on the opportunities available to long-term investors at this point in time. Over to you, Ankit.
Thanks, Alia. I grew up watching cricket where Sachin Tendulkar and Rahul Dravid were my favorite cricketers. And that made me also, start liking the sport. And I thought that I should also learn the sport. But when I started learning the sport, in few months, I realized that both Sachin and Rahul are very different. While both are excellent players, I had to choose that which style I would want to go for. Sachin is little aggressive than Rahul and known as Master Blaster. Whereas Rahul is always known for his, dependability and consistency. And hence he's known as the wall of cricket. Welcome to the PGIM India Insights. You are listening to Ankit Jain and I have with me our very own Mr. Dependable Vinay Paharia, CIO of PGIM India Mutual Fund, who will be sharing with us his thoughts on opportunities in the market. Hi, Vinay.
Hi, Ankit. Hi, everyone. Thank you for having me on the podcast.
Vinay, before we actually start discussing about the opportunities in the market, one thing I would want to know from you is what has historically worked in investing in India?
So actually, Indian markets have been on a tear. The large cap heavy Nifty 50 index has actually delivered 14% return on a 6-month basis. However, the action actually has been in the broader markets, right? The Nifty 50 mid cap index has actually delivered almost 2x more returns compared to the large cap index. And similarly, the small cap index has also delivered much higher returns than the large cap index. And naturally, in such a scenario, everyone would like to participate in this metaphorical gold rush.
Yeah.
And hence, we thought, how do we identify opportunities in the market today? So we delved deeper to see what has worked in investing in India. We analyzed 1,500 plus large companies, which have been part of the NSE 500 index over the last 20 years. And we looked at their fundamental parameters like 3-year sales growth and 3-year average returns on equity to see is there any pattern which emerges for succeeding as an investor.
Okay.
So we derived a very simple outcome from this study. Investors could outperform the market by buying a basket of companies which exhibit a combination of these two characteristics, which is companies which have higher than average historical 3-year sales growth and companies which have higher than average historical return on equity. Just by using these twin conditions, I think investors can outperform the market over a long period of time.
Sure. So what I understand from you is stocks exhibiting both growth and quality characteristics have actually outperformed the broader markets over a long term, right?
Absolutely.
Sure. So Vinay, if I can ask a follow-up question on that, why is growth important?
So Ankit, actually, for this, I will have to delve a little bit into some technicalities. So please bear with me. So let's look at some simple hypothetical examples to analyze this entire conundrum. Generally, we have been using dividend discounting model to derive share prices. So now suppose there are two companies, company A and company B, both with starting dividends of 10 rupees and at a required rate of 10%, the fair values of both these companies at the starting point is 100 rupees. In the year 5, since company A is growing faster, the dividend for company A will grow to 20 rupees, while the dividend for company B will just grow to 15 rupees, which means the underlying dividends have grown at 15% and 8% respectively. And now when you look at the fair values of both these companies, company A's value using the same methodology would be 200 rupees, whereas the company B's value would be 150.
Yeah.
So clearly that shows you growth is a very important element in judging stock prices.
Sure. So what you're trying to say is that shareholders' returns are largely determined by profit growth and the way they use their capital. And growth can actually impact both the stock price and dividend. Is that correct?
Absolutely. Actually, dividends and their underlying growth determines stock price.
This also brings me to the second follow-up question to that is, why is return on equity important? So you explained very well that why is growth important. Can you just throw some light? Why is return on equity important?
Sure. So this was another element which turned out to be very important in our study. And we tried to analyze why. And the answer was clearly coming out from simple financial and accounting facts. So profit growth is actually nothing but return on equity multiplied by the retention ratio, which means if a company earns 100 rupees annually and it pays out a dividend of, let's say, 20 rupees, it retains 80 rupees.
Yeah.
The return on equity on this 80 rupees is what determines the growth for this company.
Right.
Just for a company to grow fast, it needs to do two things. It needs to retain its profits and it has to earn a high return on equity on these retained profits. Now, if a company does not have a high ROE and it still wants to grow faster, it would need external capital to fund that growth, which will lead to dilution and will lower shareholder equity and shareholder returns.
So you're saying that companies that have high ROEs can actually finance their growth through internal accruals itself. And companies, where ROEs are low, they'll have to go to the market to take on debt on their balance sheet, and that can actually affect growth. Correct?
Absolutely. Either you take debt or you raise equity. In both the scenarios, you lower the value of existing shareholders.
Sure. So Vinay, you spoke about, how markets have behaved in the last 6 months. Everything has just gone up. Nifty has gone up X, but the mid and small caps have actually gone up 2X, 3X. So what is the current market positioning according to you?
Sure. So actually, we have tried to use the same criterion, which is growth and returns on equity, to dissect the market. Mm-hmm. And what comes out is very surprising. The current market positioning appears very dangerous for short-term investors, but presents a great opportunity for long-term investors. So if you look at the returns over the last 1 year, high growth and high ROE companies have actually underperformed by almost 6 percentage points compared to the overall universe of NSE 500 companies. Whereas weaker companies, which means companies which have got lower growth and lower than average ROE, these have actually delivered 9 percentage points higher returns compared to the overall NSE 500 average. Now, if you look at the long-term returns of these same set of companies, the good quality and high growth companies over a 5-year and 10-year period have outperformed the universe by 5% and 7 percentage points CAGR respectively, whereas the weaker companies have actually underperformed by 4% and 5% CAGR over a 5-year and 10-year period. So that clearly tells us that over a long period of time, weaker companies have delivered weaker returns. Quite intuitive, right? And stronger companies have delivered stronger returns. Once again, intuitive. However, this logic has not worked in the near term, which is the last 1 year or last 3 years.
So Vinay, as you mentioned that, lower ROE and lower growth companies have actually delivered very well in the last 1 year, 2 year and 3 year. So why you think this anomaly is going on in the market right now?
Yeah, so that also could be attributed to a reason which is a little bit technical. Now, we all know that bonds which have a longer duration get impacted more due to rise in interest rates compared to bonds which have a lower duration. Just for reference, duration measures how long it takes for an investor to be repaid a security's price by the security's total cash flows. It is also used as a measure of sensitivity of the stocks or securities price to changes in interest rates. So coming back to the bond example, bonds with higher duration will have a higher fluctuation in their prices compared to bonds with a lower duration in response to changes in interest rates. How does it impact stocks? Stocks which have a higher growth rate are like higher duration bonds.
Understood.
They will have a significant decline in their fair valuation in response to rise in interest rates. and vice versa.
Understood.
And according to us, this appears to be one of the foremost reasons for the weakness in high quality and high growth companies. Because we have seen a dramatic rise in interest rates over the last 3 years. In fact, the US Fed fund rates has increased from almost 0% to 5.25% in a span of just 3 years.
Yeah.
The Indian repo rate has actually climbed from 4% to 6.5% in a matter of 2 years. So I think these appear to be one of the biggest reasons for pulling down the valuation for high growth and high ROE companies.
Yeah.
Having said that, we think interest rates have already peaked out. We don't expect a material rise in interest rates either in India or globally going forward. And we expect that over the next 1 to 2 years, we will start seeing some easing of these rates.
So what I understand from you is that, investors may be skeptical of investing in equities because, there has been a decent run up in the last 6 months. However, you feel that there are still good opportunities available for long-term investors and specifically with, share prices of high growth companies are actually more impacted because of the sudden rise in interest rate in the last couple of years compared to, low growth companies. So there is a re-rating of high growth and high quality companies can happen if interest rates either plateaus or stays here, then eventually which starts coming off.
Yes.
So okay, that's a good view for our listeners. I think I would like to summarize our discussion in a few pointers, and when I just add wherever you think you should add some more points. We think that the unprecedented rise in interest rates is behind us, and incrementally after a long plateau, we see fall in interest rates maybe in second half of 2024, and markets may stop the compression of valuation in high growth and high quality companies in anticipation of no further rise in rates. This, along with strong earnings growth of this basket of companies, should actually result in resumption of their outperformance, compared to the overall market. Hence, people should allocate investments into high growth and high quality companies, and that's how they should participate in Indian equity markets. Is your view? And Vinay, if you would want to add something on that.
I think, Ankit, this very nicely sums up what we think. We clearly think interest rates have peaked out and the derating of high growth, high quality companies is already behind us. And here from the returns of these kind of companies will largely be driven by the fair value growth of these companies, which historically has been much superior compared to the overall universe.
Sure. Thank you, Vinay, for sharing your thoughts on opportunities in the market today. Thanks everyone for joining us on PGIM India Insights. I will catch you on the next podcast soon.
Thank you, everyone.
I think that was a riveting conversation. So many nuances that seem intuitive, but maybe we overlook as long-term investors. Now, as we always say on India Insights, it's important that you consult with your financial advisor and, of course, take expert advice tailored to your particular investment needs before jumping into the markets and making any financial decisions. Hopefully, today's conversation will enlighten you and inspire you to take a few new steps in your investment journeys. That's a wrap on PGIM India Insights, brought to you by PGIM India Asset Management Company. This is Mia Hallia signing off until the next episode. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.